Look, I'm not here to sugarcoat this. What's happening in the markets right now isn't normal. And if you're sitting there thinking you have time to figure this out later, you need to understand something. The window is closing faster than most people realize. Let me paint you a picture of what's actually going on behind the scenes. While mainstream financial media is telling you everything is fine, there's a completely different story unfolding in the precious metals markets. And it's a story that should have every single person paying attention. Gold just broke through levels that technical analysts said were impossible. We're not talking about a gentle climb here. We're talking about the kind of price action that happens when something fundamental shifts in the global financial system. The metal pushed past $4,000 per ounce, and here's what nobody's telling you. That wasn't retail investors driving that move. That was institutions. That was central banks. That was smart money positioning for something they see coming. Silver? Even more interesting. The white metal has more than doubled, hitting near $60 per ounce. Now, I want you to think about that for a second. Silver doesn't move like that unless there's a perfect storm brewing. This isn't just monetary demand. This is industrial demand colliding with investment demand at a time when supply is getting tighter by the day. But here's where it gets really fascinating. While gold was making headlines, something else was happening in the background. The ratio between gold and silver started compressing in a way we haven't seen in decades. Historically, when this happens, it's signaling that the market is pricing in serious monetary instability. It's like a canary in a coal mine, except this canary is screaming. Let me tell you about what happened in the COMEX warehouses over the past few months. Registered silver inventory, the stuff that's actually available for delivery, dropped to levels that would have been unthinkable a year ago. We're talking about a market where paper contracts outnumber physical metal by ratios that would make your head spin, and when people start asking for actual delivery, that's when things get interesting. There's a reason central banks have been accumulating gold at the fastest pace in over 50 years. They're not doing this because they think it's a good investment. They're doing this because they understand something about the current monetary system that most people don't want to acknowledge. The dollar-based system that's been in place since 1971 is showing cracks. Real, structural cracks. Think about what happened in 1971 for a moment. Nixon closed the gold window. Suddenly, the dollar wasn't backed by anything except faith in the U.S. government, and for 50 years that faith held. But faith is a funny thing. It works until it doesn't. And right now, we're seeing countries around the world quietly, systematically reducing their dollar exposure. The BRICS nations aren't just talking about alternative currencies anymore. They're building the infrastructure. They're settling trades in their own currencies. They're accumulating gold like it's going out of style. China's central bank has been adding to its gold reserves month after month. Russia converted a massive portion of its reserves to gold before recent geopolitical tensions. India is buying. Turkey is buying. Even Poland is buying. Now, you might be thinking, okay, but what does this have to do with me? Everything. Because when the world's reserve currency starts losing its privileged position, the effects ripple through every single asset class. Your retirement account, your savings, your purchasing power, all of it is denominated in dollars. And if those dollars start losing credibility on the global stage, you're going to feel it. Here's something most people don't understand about how gold and silver actually trade. The vast majority of transactions happen on paper, futures contracts, ETFs, derivatives. For every ounce of physical metal, there are dozens, maybe hundreds of paper claims on that same ounce. It's a system that works beautifully when everyone's playing along. But what happens when people start asking for the actual metal? We got a glimpse of this during the pandemic. Premiums on physical silver coins and bars exploded. You had a situation where paper silver was trading at one price. But if you actually wanted to buy a physical coin, you were paying 30, 40, sometimes 50% more. That's not normal. That's a market under stress. And here's the thing. That stress never really went away. It just got papered over. The premiums came down a bit, sure, but the underlying tension in the physical market, still there, still building. And now we're seeing it manifest in different ways. Industrial demand for silver is absolutely exploding. Solar panels need silver. Electric vehicles need silver. 5G infrastructure needs silver. We're talking about a metal that's essential for the green energy transition everyone keeps talking about. But here's the problem. We're not mining enough of it. Primary silver mines are rare. Most silver comes as a byproduct of other mining operations. And when those operations slow down, silver supply gets squeezed. You want to know what keeps me up at night? It's not the price of gold or silver. It's the complacency. I talk to people every day who understand intellectually that something's wrong with the system, but they haven't done anything about it. They're waiting. Waiting for what? A clearer signal? The signal is already here. It's flashing red. Let me tell you about a conversation I had recently with someone who manages a family office. This is someone responsible for hundreds of millions of dollars, and he told me something that stuck with me. He said, "We're not buying gold because we think it's going up. We're buying gold because we don't trust anything else to hold value when things get weird." That's a direct quote. When things get weird. Not if. When. The derivatives market is another piece of this puzzle that most people don't see. There are trillions of dollars in interest rate derivatives, currency derivatives, commodity derivatives. It's a web of interconnected bets that all assume the current system keeps functioning normally. But what happens when interest rates do something unexpected? What happens when currencies start moving in ways that break these models? We saw a preview of this when the Bank of Japan tried to adjust its yield curve control policy. Markets went haywire. The British gilt market nearly imploded and required emergency intervention. These aren't small, insignificant markets. These are the foundations of the global financial system. And they're showing stress fractures. Now, I want to talk about something that's relevant if you're sitting on significant retirement savings. If you've got $100,000 or more in traditional retirement accounts, there's a structure called a gold IRA that lets you hold physical precious metals inside your retirement account without triggering taxes or penalties. I put together a detailed guide on how this works. It's in the description below. It covers the mechanics, the rules, the pros and cons. Worth looking at if you're thinking about diversifying your retirement holdings beyond just stocks and bonds. But let me get back to the bigger picture here, because this is where things get really interesting. The Federal Reserve is in an impossible position. They've got inflation that's still running hot despite all their rate hikes. But they also have a banking system that's sitting on massive unrealized losses because of those same rate hikes. They have a government that's running trillion-dollar deficits that need to be financed. And they have a global reserve currency status that's being challenged for the first time in generations. So what do? If they keep rates high, they risk breaking something in the financial system. If they cut rates, they risk reigniting inflation. If they print more money, they risk the dollar's credibility. There's no good option here. They're threading a needle while riding a unicycle on a tightrope. And the safety net? It's made of paper. This is why gold and silver aren't just going up. They're repricing. The market is starting to price in the possibility, maybe even the probability, that the current monetary system is going to look very different in 5 or 10 years than it does today. And when that repricing happens, it doesn't happen gradually. It happens in bursts, sharp, violent moves that leave people scrambling. Look at what happened in 1980. Gold went from $200 to $850 in less than 2 years. That wasn't a gradual climb. That was panic buying. That was people suddenly realizing that their dollars were losing value faster than they could spend them. And yes, gold eventually came back down. But the people who bought at $35 in 1971, they did just fine. The people who waited until $800 to buy? Not so much. Or look at 2008. Gold was around $800 when Lehman Brothers collapsed. 3 years later, it was over $1,900. Silver went from $9 to $49. Those weren't normal market moves. Those were fear moves. Those were people looking for safety when everything else was falling apart. And here's what's different about now versus 2008. Back then, central banks had ammunition. They could cut rates to zero. They could launch quantitative easing. They could flood the system with liquidity. And it worked. Sort of. But now, rates are already elevated, and they're dealing with inflation. Their balance sheets are already bloated. They've already used their best tools. So what happens when the next crisis hits? The answer is probably more of the same, but on a bigger scale. More money printing, more intervention, more distortion of markets, And every time they do that, they erode confidence in the currency just a little bit more. It's death by 1,000 cuts. Except we're not at cut number 50 anymore. We're at cut number 900. I want you to think about your own situation for a minute. How much of your wealth is tied up in assets that are denominated in dollars? Your bank account, your retirement account, your bonds, even your stocks, they're priced in dollars. If the dollar loses 20 or 30% of its purchasing power over the next few years, what does that do to your lifestyle? What does that do to your retirement plans? Now think about gold and silver. They're not denominated in anything. An ounce of gold is an ounce of gold, whether you're in America, China, or Switzerland. It doesn't have counterparty risk. It doesn't depend on someone else's promise to pay. It just is. And in a world where promises are getting harder to keep, that matters. The smart money understands this. That's why you're seeing institutional allocations to gold increase. That's why family offices are buying physical metal. That's why central banks are accumulating. They're not doing this because they're gold bugs or conspiracy theorists. They're doing this because they understand risk management. They understand that when everything else is uncertain, gold and silver provide a foundation. But here's the critical part. There's a difference between buying gold at $1,800 and buying it at $4,000. There's a difference between buying silver at $20 and buying it at $60. Yes, these metals could go much higher, probably will go much higher if the monetary system continues on its current trajectory. But the best time to hedge was yesterday. The second best time is today. The worst time is when everyone else is panicking and premiums are through the roof and you can't even find physical metal to buy. We're already seeing signs of this. Dealers are reporting longer wait times for delivery. Premiums are starting to creep up again. The U.S. Mint has had production issues keeping up with demand. These are early warning signs. These are the things that happen before a market goes truly parabolic. And let's talk about what parabolic actually means in this context. When gold went from $35 to $850 in the 1970s, that was a 24x move. When it went from $250 to $1,900 in the 2000s, that was a 7.6x move. If we're in the early stages of another major bull market in precious metals, and I believe we could see moves that dwarf what we've already experienced. Gold at $10,000, silver at $150. These aren't crazy predictions. These are mathematical possibilities based on historical precedent and current monetary conditions. But even if we don't see those extreme moves, even if gold just holds its current value in real terms, it's still doing its job. It's preserving purchasing power. It's providing insurance against monetary chaos. It's giving you optionality in a world where options are becoming increasingly valuable. Think about it this way. If you're wrong about needing gold and silver, what's the worst that happens? You own some shiny metal that holds its value reasonably well over time. You can always sell it. You haven't lost everything. But if you're right about needing it and you don't have any, that's a very different situation. That's watching your purchasing power evaporate while you scramble to find protection that suddenly become very expensive. This is why I keep saying, the window is closing. Not because gold and silver are going to disappear. They're not. But because the opportunity to acquire them at reasonable prices, with reasonable premiums, with reasonable delivery times, that opportunity is finite. Once the broader public catches on to what's happening, once the panic buying starts, you're going to wish you had acted sooner. I've been watching these markets for long enough to recognize the patterns. The accumulation phase, where smart money quietly builds positions. The markup phase, where prices start rising but most people aren't paying attention yet. The public participation phase, where everyone suddenly wants in. And finally, the blow-off top, where prices go parabolic before eventually correcting. We're somewhere between the accumulation and markup phases right now. Maybe early markup. But we're not in the public participation phase yet. That's coming. And when it does, it's going to be intense. The geopolitical situation is only adding fuel to this fire. You've got tensions between major powers at levels we haven't seen in decades. You've got supply chains that are still fragile from recent disruptions. You've got energy markets that are volatile and unpredictable. You've got food prices that are elevated and concerning. All of these things feed into the precious metals narrative because they all represent instability. And instability drives people towards safe havens. Here's something else to consider. The mining industry isn't keeping up with demand. It takes years, sometimes decades, to bring a new mine online. Environmental regulations are getting stricter. Energy costs are rising, labor costs are rising. The easy-to-mine deposits have already been mined. What's left is deeper, lower grade, more expensive to extract. This means that even if demand stays constant, which it won't, supply is going to struggle to keep pace. And on the demand side, it's accelerating. Industrial demand is growing. Investment demand is growing. Central bank demand is growing. Jewelry demand in Asia remains strong. You've got multiple sources of demand all pulling on a supply that's relatively inelastic. That's a recipe for higher prices, much higher prices. But beyond the price action, beyond the charts and the technical analysis, there's something more fundamental happening here. There's a loss of faith in the current system. You can see it in the data. You can see it in the way people are positioning. You can see it in the questions people are asking. They're not asking if the system is sustainable anymore. They're asking what comes next. And that shift in mindset, that's what drives major market moves. When people stop believing in the stability of their currency, they look for alternatives. Throughout history, that alternative has been gold and silver. Not because they're perfect, not because they're going to make you rich overnight, but because they've survived every monetary crisis, every empire collapse, every currency debasement for thousands of years. They're the ultimate survivors. And in uncertain times, survival is the most important thing. So here's where we are. Prices have already moved significantly. The trend is clearly established. The fundamentals are supportive. The technicals are bullish. The sentiment is shifting. And the window for getting positioned before the real move happens is getting narrower by the day. You can wait and see what happens. You can hope that everything works out and the system stabilizes. Or you can take action to protect yourself and your family from what increasingly looks like an inevitable monetary reset. The choice is yours. But understand that choosing to do nothing is still a choice. It's a choice to remain fully exposed to a system that's showing more cracks every day. It's a choice to bet everything on the status quo holding together. And maybe it will. Maybe I'm wrong about all of this. Maybe the central banks will figure it out. Maybe the dollar will remain strong. Maybe inflation will come down and stay down. Maybe the geopolitical tensions will ease. Maybe the debt will somehow get paid off. Maybe. But what if I'm right? What if we're in the early stages of a major monetary transition? What if the next few years look more like the 1970s than the 2010s? What if gold and silver are just getting started on a move that will define this decade? Are you positioned for that possibility? Because if you're not, and it happens, you're going to be one of the people scrambling to buy protection at prices that make today's levels look like a bargain. The time to hedge isn't when the crisis is obvious to everyone. It's when the signs are there, but most people are still in denial. It's when you can still act calmly and rationally instead of emotionally and desperately. It's now. Right now. Before the window closes completely, and you're left wishing you had listened to what the market was trying to tell you.